Let's just start with me right now. Good morning, everybody. I am Mark Sebastian. I am the CEO and founder of OptionPit.com. I'd like to welcome you all to our State of the Market show. I want to remind you that we're here every day at 10 a.m. delivering education and actionable ideas to help you become a better trader. Well, today is Fed Day. Today, my plan, I'm going to explain to you exactly what is the Fed Day and what is it, why is it so important. We're going to talk about what are the ramifications, what are people looking for, a little bit on why does the government want the Fed to lower rates so bad, and then we will kind of talk a little bit about what is next after this meeting. Before that, I do want to remind you that today at 1:45, Andrew and I are going to be live for the Federal Reserve, helping you trade and react to what is going on there. What is Powell saying? What does it mean for markets? So that's where we are. So real briefly, before I get into the Fed, I just want to run down a little bit of what's happening in markets today, because we've got kind of a mixed bag. On one hand, and now you can show my screen. On one hand, you've got the Qs down, I'll call it 0.25%. You've got the S&P down. You got the Dow up, and you've got the Russell 2000 up and up nicely. Believe it or not, none of this should be shocking you ahead of the Fed. We'll talk about that a little bit more. But just kind of be aware that the Fed announcement isn't until 2 p.m. Powell doesn't go on until 2:30 p.m. Things are going to be choppy. They're going to be choppy. Because nobody really wants to put a big leg out in front of this huge announcement. Nobody. I mean, I don't. If I'm looking to close winners, pair off, small losers, but I am not looking to open a bunch of new positions ahead of the Federal Reserve. Neither are banks, hedge funds, anyone. So you could see a little bit with the S&P sitting at all-time highs. We're $10 off the top. You could see a little bit of selling ahead of that as some money comes off. Same thing with the triple Q. But that money is currently kind of moving into industrials, and it's moving into the Russell 2000. We'll get into why in a second. So here's a question for you. How many of you actually know what the Fed is changing today? Right? We are expecting the Fed to lower rates by 1/4 basis point. If I go to the CME Fed Watch tool, this is a tool that is basically tells us what the Fed is going to do. They're pricing in, and when I say there, I mean traders, banks that trade something called Fed Fund futures. They're trading these Fed Fund futures, and they're currently pricing in a 94% chance of a 1/4 point rate cut and a 6% chance of actually a 50 basis point rate cut. So Kat says the probability are for a 1/4 basis point. Scavenger says the Fed fund rates. Blick says Fed funds. Woodchuck says institutional. Northport Florida Man says overnight repo. How many people actually know what a Fed fund is? How many people actually know what a Fed fund is? All right. So banks, they're constantly taking in deposits, taking in loan replacements. They are taking in, they're making interest. They're making money off of their trading practices. But at the same time, banks are also loaning out money. All right. Banks are actually loaning out money. Now, generally speaking, the Federal Reserve is the lender of last resorts. So these Fed fund rates are essentially how banks loan money back and forth to each other. Now, I'm JP Morgan, and I took in $100 million in deposits, and I had $120 million in outflows. And I don't want to dig into my balance sheet, but I know tomorrow I'm going to have $150 million in deposits and loan payments, and I'm only paying out $80 million. So banks loan money back and forth to each other constantly. JP Morgan loans to Morgan Stanley. Morgan Stanley pays it back the next day. Morgan Stanley loans to Goldman. Goldman pays it the next day. These loans are literally overnight. You borrow at night, you pay back in the morning. And the rate those loans are set at or paid by is called the effective funds rate. And that is set by the Fed funds rate, which is, again, what the Fed is, how much the Fed charges if banks need to borrow money from them. Now, do banks ever borrow money from the Fed? Almost never. They like to borrow from each other. It's not a good sign for the bank to need to go to the Federal Reserve. So the banks actually loan to each other. So the Fed fund rates sets that level. It's kind of the level that banks are loaning money back and forth to. So if that rate is dropping, how do you think that affects bank operations? And what are the effects to big companies like General Electric, IBM, you name it? You see, the Fed funds is the basis for all activity across the entire United States economy. As you move further away from the Fed, the waterfall, the effect becomes more muted, becomes more market-driven. But the Fed funds rate is the basis for which all activity happens in the United States, like it or not. So the Fed funds rate is kind of the basis. Come on. For Treasury markets. How much does it cost the Fed for the government to borrow money for 3 months, 6 months, 12 months, all the way out to 30 years? I want you to notice the yield. This is U.S. Treasury bonds. I want you to notice the yield. 3-month pays 3.97%, 6-month 3.82%, 12-month 3.6, 2-month or 2-year 3.52, 5-year 3.6, 10-year 4.02, and the 30-year 4.63. This is called the yield curve. And the structure we're looking at now is pretty unique because it's partially inverted. Partially inverted meaning a 3-month treasury, a 3-month bill is more than a 6-month bill, is more than a 12-month bill, is more than a 2-year note, which is less than a 5-year note, which is less than a 10-year note. Now, as the Fed adjusts these rates at the Fed fund rate, it affects trading in the 3-month and so on. So these all trade, these treasuries, the method in which the federal government borrows money, trade in the free market. So the Federal Reserve has no direct control over where these rates go. Zero. However, the waterfall effect, the trickle-down effect of rates coming down does get into these rates. The bank can borrow money overnight cheaper, which increases their liquidity. That increasing liquidity allows them to trade in something called the commercial paper market. GE has similar needs to JP Morgan. Think about it. I make an aircraft engine. What goes into the process of making that aircraft engine to being delivered and me getting paid? So GE doesn't get paid on that aircraft engine. They deliver it to Boeing or Airbus. But in the meantime, they need to pay materials. They need to pay for energy. They need to pay for labor. They need to pay all kinds of stuff. So every day, GE is delivering aircraft engines and power and you know what. And every day they're also having to pay for, their property, their energy, their labor, all the inputs that go into an output. Now, most of the time for a name like GE, they're bringing more than they're paying out. But they will have dips of a day, 2 days, 3 days, where maybe, hey, my outflows aren't matching with my inflows right now. I need to go into the commercial paper market and borrow $100 million. The duration of commercial paper is usually less than 30 days. Duration is another word for how, when that bond needs to be repaid. So once you get into how companies are paying, if companies are paying less to manage their cash flows, well, then they're going to have more liquidity and so on. You have excess liquidity. What do you do with it? Two things. You invest in growing your business, hire more people, do a tech build out, AI, whatever. Or you take that money and you put it in the bank and get an interest rate out of it. The bank knows they have to pay that interest. So what do? They go into the treasury markets and buy treasuries. If I'm buying, if there's more demand for bonds from the federal government, what happens to interest rates? All right. Well, so if demand for bonds go up, what happens to interest rate? All right. So here's the thing you have to remember. The bond price will go up just like a stock. But when bonds prices go up, what happens to interest rates? Right. When bonds go up, interest rates go down. And just the anticipation of the federal government lowering the Fed funds rate has already started that waterfall effect. This is TLT. It's had a very rough go since 2020. At the peak of COVID, TLT was $170. TLT is an ETF that holds long-term bonds from the federal government. They buy 20-year bonds, 30-year bonds. So if you look at TLT and its price drop, and we're talking about a 30-year bond from the federal government, what has happened to interest rates since 2020? And many of you should know this. What has happened to interest rates since 2020? Yeah, they've gone way up. All right, so when interest rates go up, that changes the bank's eye line with how they deal with you. Am I going to loan you money for a mortgage at 4% when I can buy a 30-year treasury, a 30-year bond, and get a yield of 4.63? No. So, what is good for the economy? And today the news was out. We had huge loan refinancing and mortgages. Why? Well, since Labor Day, TLT is up about 7%, which means demand for long-term bonds is going up. Demand on long-term bonds goes up. That interest rate that the federal government has to pay goes down. And thus, your mortgage starts to drop. The rate that they're willing to loan money out at the bank starts to drop. Now, there's more pieces to this. Hopefully now you understand that this Fed fund rates has a waterfall effect across the entire economy. We've seen it already waterfall all the way out to the 30-year bond that the federal government uses to borrow. And you've seen that waterfall reach individuals because people that bought houses at a 7.5% rate are refinancing at a 6.75% rate. If my interest rate drops, what happens to my housing payment? What happens to that monthly mortgage that I'm paying every single month? It's going to drop. It's going to drop. So if my mortgage goes from $2,000 a month to $1,750 a month because I refinanced, what does that open up? Money to me. An extra $250 a month. Doesn't sound like that's $3,000 a year. Even if I'm making $100,000 a month or $100,000 a year, $3,000 is $3,000. So I can invest that money, or I can go out and I can take my kids to Kalahari Resort or to, an extra trip to Great America, or we can order in dinner. Most people go the latter. For some reason, I have a feeling that this audience would go with the investment side. So if you got an extra $250 a month, what would you guys do with that money? Steve said he had more to spend on trading. Tommy Y says, I trade. Rawhide says, I wouldn't give it to my wife. Rich C says, invest. Woodchuck is trolling me. He's saying he'd buy Crocs. Yes. So we can see most of you would maybe invest it. Some people go spend it. Gag says, more on option pit products. I like your thinking, Gags. All right, so why does the Federal Reserve, why is Donald Trump and really all lawmakers pressing for the Federal Reserve to lower these rates? Anyone got any new ideas? Steve would buy a new metal detector. Scavenger says there's too much debt. Steve-O says open up the finance gates. Rich has got it right. Tommy says build up the economy. Losses basis deficit. William says art of the deal. Stimulate housing market. All right. So how much debt does the federal government have? Trillions, right? Trillions and trillions. I think it's like $26 trillion. When you have $26 trillion in debt, and that debt is not free, right? They're paying interest rates on it. Debt going out 30 years, if they issue it, they're paying about 4.63% a year on that. Yeah, there you go. Cat says 37 trillion. That sounds about right. Now, they have to pay that interest. They have to pay that interest. I showed you that chart of TLT. Here's another one, IEF. This is the chart for a 10-year treasury, 7 to 10 years. It's also gone up. It's also gone up. Now, when the government needs to borrow money, they have to pay off the interest monthly. If interest rates go down, what happens to that interest rate payment the federal government has to make? What happens to the interest rate that the government has to pay? It goes down. So what happens to the federal deficit? The federal deficit on the year will go down. And so the government doesn't have to pay as much. That makes that federal deficit that's so big come in. But here's the thing. Fed and Powell need to get this perfect. Perfect. Right? I've just explained to you how dropping rates puts money in the consumer's pocket, puts money in corporations' pockets. But what if they put too much money in corporations and in consumers' pockets? What happens to inflation? It goes up. That's one of the things Fed doesn't want to deal with. That's one of their mandates. What if they lower rates too slow? The economy can go into a recession. So they have to get this perfect. Who here thinks they're going to get it perfect? I'll tell you, in the history of mankind, there's been one total perfect person. And even that person, I'm not sure can handle the federal deficit. So, if they don't get it perfect, and I believe they won't, they're going to do something they haven't done in 15 years. What is that thing they're going to do in 15 years? Andrew and I are going to reveal that today at 12:45. And what they're going to do that first thing in 15 years is going to have just cascading effects across the economy. For those of us here, for those of us that had to recently buy a home in the last 3 years, it's going to be a huge benefit to you. To Valentino, who's 9 years old, it's this generation kind of putting up the middle finger. So, what I want you to do is join me and Andrew here today at 1:45 Eastern Time. I'm going to walk you through what is exactly going to happen, how it's going to play out, and how it affects you. Plus, we're going to have some fun reacting to the Fed. We're going to have a ton. We're going to have a good time. We'll maybe make some money. We can see a good trade. And I'm going to finish up this story about where the Fed is going. Folks, I want to remind you that we're here every day at 10 a.m. On Mondays, we do our ticker highlight show where we reveal one great idea. I know, I can't believe it either. Mike said he's 9 already. I can't believe it either. But I'm going to reveal that one thing. So join us here every day at 10 a.m. State of the market on ticker highlight show on Mondays. State of the market Tuesday through Friday. We give you actionable ideas every day, educate you, teach you, and answer your questions. And again, join me this afternoon at 1:45 p.m. Eastern Time. All right, everybody. I am Mark Sebastian. I am your only option, and I can't wait to see you at 12:45.